Good morning, everyone. It's Brian with Fundamental Research. Welcome to the third part of our webinar series, Sorting Through the Noise, Investing in Stocks, Where to Start. Really excited to present this one. When we did the practice run yesterday, our team said that this was the best one yet. So hope you find it useful. Before we get started, some disclaimers and disclosures. This webinar is for information purposes only. It's not meant to be financial, investment, tax, or legal advice. Everybody's situation is unique, and you should consult a professional before you take any actions. If you have questions during the presentation, please just send them through the chat. Also, nothing in this presentation should be construed as investment advice. I will be going through specific examples in this presentation using real stocks. Doesn't mean we're endorsing the company, and vice versa. They're just meant to be examples. I'm going to go through a live stock screener. I don't know which company it will pick, and we're going to analyze it together. So it's not an endorsement of that company. You should consult a professional. Anytime we're talking about future or past performance, it's not a guarantee that it's going to continue. And we may receive compensation from companies mentioned in this presentation. So just an overview of what we're going to be discussing today. Who we are, why is it so hard to beat the market, um, gaining an edge, and how to filter noise, stock screener, customization, how to do an analysis really quick on a company. I'm going to go through a due diligence checklist, and then we'll get into the Q&A that anybody has sent through. So, brief overview who we are. We've been around since 2003. When I initially wanted to start the company, I loved equity analysis, but I didn't want to be the 40th analyst covering Walmart. I didn't feel there's any value that we could add beyond that. And this is a very relevant topic especially for this presentation. You'll see specifically why we initially focused on small cap companies. And since then, we've evolved into a platform. And our mission is basically to bring you guys the tools that the larger players have to analyze stocks. But also, when we designed the platform, I wanted one place where I could analyze a stock and not have 10 or 20 different windows open. So I said, when I'm analyzing a stock, this is the information I want. Let's have it all in one place. And I'm going to show you how that makes it so efficient to analyze a company really quickly. Um, for those of you that are attending the presentation, we have created um, basic subscriptions for everybody. And also, as a way to thank you for attending the presentation, we have a special offer where you will be able to insert this discount code into the upon checkout, and you will be able to receive a discount on the premium subscription. So just quickly, the difference between the premium and the basic subscription, you'll have with the premium subscription, you'll get research in real time, unlimited fair value analysis versus the basic, which will have a limited amount of queries. And to get started, you just need to click here, which will take you to the page where you can enter the promo code here. And just before that, you just need to choose whether you want to subscribe annually or monthly. If you do the annual plan, you will save an additional 20% on top of the 20% from using this code. So some of the key features of the platform, the fair value analysis. So this is the same algorithm that we use to analyze stocks and put our own money into the market. And we've made it accessible to our subscribers. So it basically calculates a fair value on thousands of stocks. So let's say you come across a company you like, you run the analysis using the tools I'm going to show you. The question is always at what price? And this will help you sort of give a yardstick of whether it's relatively over or undervalued. If you want more information on that, we have videos on our website that we have. I suggest you watch the two previous webinars, and I'll show you how to access that. If you go to intelligence videos, you can watch these two, learn how to invest like the pros, as well as stop guessing. This one is a very in-depth webinar on valuation. This one is a general overview of investing. We also have institutional quality research. So this is the same research that larger investors have access to. Our analysts cover a number of stocks, especially in the mining sector. So there are very highly ranked in terms of metals, gold, silver, uranium, rare earth metals, you name it. Our analysts are very knowledgeable in that space. Um, as well as others, but we do have a large expertise in the mining sector. Curated portfolios, these are companies that our analysts have the strongest conviction in, and one-stop stock analysis, which I'm going to show you shortly. Okay, so let's get to the topic of today's presentation. Why is it so hard to consistently beat the market? In order to understand this, you need to understand a concept called efficient markets. So basically, the theory is millions of investors are all using the same information and basically competing against each other to make a profit in the stock market. The easiest way to think about this is imagine you are on the street in Manhattan. Thousands of people are walking by, say, Fifth Avenue at any given point in the day. Okay. Let's say somebody dropped $100 bill on the street. How long would you think that $100 bill would stay on the street for? Probably in less than a second, it would be gone. And that's basically the concept. There's so many people looking for profit that when it's spotted, it's going to be gone in a second. So, in order to be successful in the market, you basically have to be more right than others. What do you know that others don't? Or you form an opinion that is contrary to the consensus and it comes out correct. So, I'm going to show you throughout this presentation how that can be achieved. Um, to further solidify this concept, imagine, let's look at the gold market. Okay, so gold sells in New York and London. So, what would happen if 1 ounce of gold was selling for $5,000 in New York and only $4,000 in London? So, what would happen is because there's millions of people looking at these prices and these markets, there would be a lot of buying in London. That buying is going to drive the price up from $4,000. It's supply and demand, right? And then they're going to take that $4,000 gold ounce bar and they're going to sell it in New York for $5,000. Well, that's going to create selling pressure in New York. So what will happen eventually is the price in New York will come down and the price in London will come up. And it'll reach a point where that riskless buying and selling is no longer possible. So we call that in finance arbitrage. So if you ever come across that term, that's basically what it means. So um, you can see that these opportunities wouldn't last long. And also, there's other factors that might cause the price to not fully equalize to be exactly the same. For example, transaction cost. If I had to pay, say, $1 every time I bought in London and then pay $1 when I sell in New York, so the price would be off by $2 in each market, but they would be the same after transaction costs. So that is an example of why it's very difficult to beat the market. So knowing this, let's look at the implications for different strategies that people use to try to make money in the stock market. So let's first address technical analysis. So technical analysis is basically looking at charts to find patterns in stocks and then trade based on those patterns. So why is it so popular? In my opinion, it's popular because it's easy to do. Anyone can look at a chart. It's easy to learn. You don't need to go to business school to learn about, economics, finance, accounting, et cetera, et cetera. Brokerages might push it a lot. We have the best charts, whatever, because it encourages people to trade. Um, and that's how they make their money, right? So why is technical analysis and in relation to what we just discussed about efficient markets, not, in my opinion, the best tool? Because millions of people are looking at the same chart, the same pattern. So once that is recognized, it's highly unlikely that you would have any sort of advantage over another investor looking at the same pattern. Okay. So now we move on to fundamental analysis, which happens to be the name of our firm. Why did we adopt this philosophy of investing? It's because fundamental analysis is basically approaching the um, the stock selection process as a business owner, right? So if you were going to say open a barber shop, you would look at traffic patterns at the corner where you're going to open the barber shop. You would look into what permits you need, how many chairs you should have, how much you should price the haircuts, how many barbers you're going to hire, what you need to pay them, what the profitability of the business would be. And in the long run, whether you're going to make money or not depends on your skill in running the business, but also identifying these factors, right? So that's how we're approaching stocks. And I think with that, you can gain an advantage over other investors. And we'll get into a lot about that later on in the presentation. So, what about using AI? So, this is huge right now. It's on everyone's mind. I feel, and at the firm, we feel it's an amazing tool to help you for heavy lifting of data and learning quickly about a company. But you still need intuition. From personal experience, I've tried setting AI. For example, I will upload my portfolio to ChatGPT and I will say, give me a Monday mo or a morning briefing on each of these companies that I'm following, scan all the news, summarize it for me. And it will do it for some days it won't. Sometimes it'll miss companies. It might not pick up all the news. So that's one reason why, for me, it's not reliable at this moment. The other thing is AI cannot pick up small nuances that analysts can. For example, when our analysts sit down with a CEO and we grill them about their numbers, you can pick up who knows their numbers and who doesn't. If I ask this, let's say I'm sitting down with a CEO of a restaurant and I say, what are your labor costs? What are your food costs? And they kind of fumble around. Those are two numbers you should know off the top of your head, right? So by speaking to a CEO, AI cannot gain this kind of nuance in different human interaction. Um, so what is it good for? It's good for data, processing a huge amount of data and finding maybe patterns in that data. It's also really good for learning quickly about an industry. So let's say I come across a company that looks good in terms of the numbers, and I want to know, what does this company do? So historically, I go to the website, and sometimes, especially if it's in a high tech sector or maybe biotech, it's really hard to piece together like what exactly does this company do. But AI is great for putting that name of the company and saying, okay, what do they do? How do they make money? And it'll break down for you very quickly that. So for that, it's amazing. Whether I would trust it for other ways, I don't think at the moment I would. We don't know where it's getting its data from. It's kind of a black box, right? Um, Next is the news. So again, if millions of people are watching the same news program, it's highly unlikely that you would pick up any information that anyone else doesn't. Um, so it becomes a minimum standard, right? So if everyone is reading the Wall Street Journal, it's highly unlikely that you would gain any information advantage over another investor by reading the Wall Street Journal. But you have to read it because everyone else is reading it. So it becomes kind of the status quo. Um, I also like to think about looking at data and using past performance. I like to use the analogy of driving while looking in the rear view mirror. So imagine you don't look out the front window and you only look in the rear view mirror. You can probably be fairly safe as long as there's no other cars on the road until there's a sharp turn in the road, right? So every time you drive, you pick up a little bit of information. The road is straight, the road is straight. Maybe even if it turns a bit, you're like, okay, we're starting to turn, I better turn the car. But if there's a sharp turn, then you're going to miss that by only looking at past data. And that's the problem with technical analysis and AI. It uses data that is already known to kind of predict the future. So it might work until the sharp turn comes. And that's where you need the human intuition to say, okay, we've been in this before. And I think I know, based on certain factors, what is going to happen.